Hey, and we're live. It is 5:50 Eastern Time on Sunday, May the 31st, and dawn in Hong Kong. Welcome to another unmissable Sunday show. I'm drinking out of my thank you big for my 852, which is the Hong Kong country code. Thank you for my mug, but little birthday gift that got dropped off at the hotel from last week.
How much longer are you in Hong Kong?
Oh, I thought I was going to be out tomorrow. I am. I'm here. I'm here until the end of the week now.
Well, you got to. Everyone watching the Unmissable Sunday show is going to miss that nice view of the bay.
Yeah, you're back to the bookshelf.
They've seen it dark when we had Larry on, and they've seen it light. It has been a staple. When you think about our show this year, Rupert, we've kind of had a lot of international cities covered, right? And I'll be in Europe in the summer, and we'll get a little there. And so anyway, let's get going. People don't want to hear about our.
Let's do this. Right. We've just finished Q2, which I have to confess, I stunk in Q2. I kind of sat on my hands and sat out the market. So basically there's one trade and everyone knows it. It's the semis. So, the bright green lights ignoring the levered funds are Korea, Taiwan, and the SOXX, right? Everything else has been kind of meh, or if it's a broad-based index, it's been dragged up by the semis, right? And looking at it another way, you've just got this parabolic move in SMH, and that's good. So you got SMH in blue, Korea in green, the Qs futures from Qs futures in red, and even good old EM, right, which is now basically a semis ETF in disguise. What are you doing over there, Benny?
I was trying to put the fan on. Sorry, I apologize.
Okay, that's all right. But listen, let's take a step back. Micron is now trading on not quite record, but the last time it was trading anywhere near this zip code, it was just at the peak of the last tech boom, right? But I think it's sometimes important to look at market cap charts instead of share price charts, because it just puts in perspective just how value perception of this industry has changed over the last.
But to be fair, the problem with the market cap, any nominal chart, is you get the hockey stick, right? Everyone's like, "Oh, yeah, look at the dollar." I feel like you got to log chart that, to be honest, just to push back a little bit, and that's why people like valuation charts or anything that can kind of normalize things, because you can take the time compounding element out of it, right? Of since 1971, there's a lot more dollars, right, or whatever. But let's talk about this for a second, Rupert, because I was on a conversation with one of my partners at Wall Street Beats earlier, and we were talking about this whole. And one of my other buddies who runs a hedge fund in his quarterly note or monthly note was talking about the picks and shovels and the guys who are in the recipients of the Capex boom, which is clearly one of them. What is the multiple you put on peak earnings, right? And is price to sales the right multiple? Is it price to earnings? But clearly we're in rare air here, okay? And
I just saw it. Yeah, go on.
Oh, no, I was just gonna say, and to be fair, I think the peak price to we were getting close to it. I was already starting to roll a bit there.
Yeah, and then I saw a great tweet by your buddy Dale this morning, and saying that earnings expectations are the classic lagging indicator, because analysts are always looking to chase the narrative created by the stock price, so they have to bump their forward earnings. And this is the peg that everybody's hanging their hat on right now, right? This market is defensible because all it's doing is keeping up with earnings. Are you sure it's not the other way around, right?
And there was a good conversation I had, and I think I saw a tweet on it too from them. I think it was the guy from BCA. You can have two different kinds of bubbles. You can have a 1999 price bubble or 2021 price bubble, the COVID winners, right? And and even to be fair, we had a little bit of a price bubble last fall, right? September, and then it ended in October. The Occlos of the world and crypto and some of the stuff. This could be much closer to what a housing bank 2006, 5, 7 before the GFC type of bubble is, where multiples were, they weren't ridiculous, but earnings were just completely over earning. So you can have an over earning, but you have an earnings bubble basically.
An earnings bubble.
Yeah, an earnings bubble. Yeah, exactly.
Yeah, I don't pay for BCA, but I saw the front cover of Peter Berrison's piece. It made a lot of sense for it. It made a lot of sense to me. I mean, I should just say, so the reason these charts are called amnesia 1, 2, and 3 is because, you know, that I've got amnesia because my portfolio's got amnesia because it's got no memory. Or it had a little bit. I took off the call leg of my SMH strangle last week. It cheapened up my September puts by about 15%. So I'm taking that as a win. But what I really wanted to say is, guys, people that have ridden this memory bull so far this year, congrats. But it's really congratulations. You guys have rocked it. And all I would say, it's time to take some of those DRAM chips to the cage, right?
Well, this is why it's a very difficult situation, because, you know, I like volatility. When you trade volatility, you get that kind of move, but you know inevitably it's going to spike back down, right? You're going to give it up. And so monetization becomes the actual hardest part of the trade, because it's easy to see, hey, vols here, the implied correlations here, and I know that there's a chance we could have fundamentals and people start putting on. Same thing here. Like, you know, if you saw it, you're like, hey, the transformer LLMs like basically have a problem with memory, where when you have context double, compute quadruples, and it's a huge boom for an industry. Why the scroll was probably not there is because he's refinanced SK Hynix a couple times. So he knows the underlying commodity nature of this business. And, you know, to go back to Micron, I bought that in like 18, around when Einhorn bought it like $8, because there was no supply left in the market, because it's not a good business. You know, or historically wasn't. Maybe in this new world it is. We'll to be TBD.
Well, I mean, you know, it's the closest thing in tech to a commodity, all right, an old-fashioned commodity. And you know what? Cyclical commodities always look cheap at the top, right? And that is, and the other way of saying it is, there is no such thing as a value semiconductor play, right? That's my other favorite mantra. And then to be honest, you know, you've just got to have the words of this great man, Scott McNealy, ringing in your head. Take a moment, read it, right? Think about what is implicit in paying 8 times revenues for any business, right?
Yes.
You know, what you're looking at is crazy. It's human instinct, but crazy extrapolation, right? And yeah, go on.
Well, I was going to say, I think that's the thing, is like in a market where 55%, 54% is passive, okay, they're not thinking participants. And you have a lot of people chasing, whether it's pod shops, retail, CTAs, you know, there's a lot of momentum strategies. And then even the guys who are thinking participants, you know, the minority discretionary players now, they need to keep up with the S&P. And so you have this like dynamic, and the guys who shorted, like us in April with SMH, you know, you got ran over. So there's no one left on the other side. And you don't have people being like, well, what is the long-term economics of this? Or what if we pull up a chart, and Rupert will pull you a nice, you know, Excel chart, and we go through it, what it implies. And I think that's your point, right? Like that was a great letter when he like laid that out.
Yeah, no, I mean, so what I would say, I mean, so that was, you know, Scott McNealy, and he said that back at the beginning of the century, right? It was all happening, right? His stock was the hottest thing, and he was going, "What are you thinking?" Right? And and the other thing is, I mean, to this point, and back to this sort of physics supply demand point, if you look at, you know, ground zero in this bubble in Korea with Hynix and Samsung, you are running out of institutional buyers, because, you know, you've got single name concentration issues. So, you know, the big wave of institutional money is exhausted, or at least very close to exhaustion. They're starting to get creative by owning things like SK Square instead of direct SK Hynix. And, you know, that's, you know, we're running out of buyers, right? And so much of the marginal dollar. So wait one sec. So much of the marginal dollar here is these structured product, these leverage ETFs and leverage ETNs, and that leverage works twice as aggressively on the downside.
Yeah, and I was just going to say that, so you beat me to it. We're a good team.
Okay, fantastic. Well, as a result of this, I'm in pain, Benny. Look at the S&P's the red line. I've gone from outperforming the S&P year to date at the end of Q1 to being behind. But that delta at the beginning of April was what, damn nearly 16%.
I mean, it comes back to what I told you. I'm one of the great Q1 traders of all time. Terrible Q2 trader. I hate the Q2, and it's been the same for me. And so don't feel bad. I think there's a lot of guys.
I'm not, because
really struggling right now.
Yeah, I'm not feeling bad. I'm not feeling bad at all, because I said it at the beginning of March. I said, this market's looking at me funny. I don't trust it at all. And I've been, comprehensively under risked. And you know what, if you zoom out a little bit further, I'm still ahead since the beginning of last year, and I'm relaxed. But I mean, my point about that is really, even though I've only got 30% equity weighting in my multi-asset portfolio right now, and over half of it is energy, and I still feel I'm not long enough here. And I keep on threatening to get involved at the front of the curve. And this is the BNO ETF that rolls the front month Brent against, shaded behind it, the front month Brent future. I just want to hang out in BNO. BNO even sounds like Benny.
Did you see the inventory charts that have been floating around lately? I mean, inventories have really gotten decimated, right? So I think that's where we sit, where it's like, it's actually kind of amazing, Rupert, when you think back to the first night of the war, when the things were open, we're like, fade this at your peril, boys. And they faded it from 73 to 70 quick, before it just blew to 120 or whatever. 150, I don't remember the exact high in the front month. But I think that's it. It's like, we haven't had that explosive 150, 200 because we were really well inventory. There was a reason why oil was at 55 bucks at the beginning of the year, right?
Listen, I love the fact that, the barrel counters came into this year really bearish. When you think about great Paul Stanke, Rory Johnson, right? People that I hugely respect in the energy market. The barrel count, and they're proper barrel counters, they came into the year bearish. And now they're tearing their hair out. They're lighting their hair on fire. And you know what? I kind of trust their analysis, actually. And I like the way they're thinking it through. It appeals to me. It's numerical. The numbers matter.
Yeah, absolutely. Let's keep moving.
Yeah. So until, I think I was waiting for a final dump in Brent on some kind of capitulation, pieces breaking out. But I'm getting close to it. Not waiting for that. Or maybe I'll put half the position on this week. Still undecided. I can't even decide what kind of. We've become so inured to this. Is this a peace dividend open on this Sunday night, or is it one of the ones that's bearish? I don't even know. Right.
And what's interesting is that as we move on to this part of it, I think there's a lot of people who are like, what is going on? And that's kind of why my part of the slides I put in was like, let's just do some sanity checks, because I'm doing a bunch of work on CoreWeave right now, and I'm doing a bunch of work on the numbers behind that Capex. You guys know that I've done a lot of work in the last 5 months on the mechanics and all this stuff. And I guess what we come out at is like, look at the Russell's free cash flow yield, like versus 21, right? Like, I mean, it is thin, and the Qs is thin, and the S&P is okay. Not as aggressive, but it's, it's thin, right? And then, that just tells you, because we have
this is trailing, right? This is trailing, yeah.
This is actually trailing.
LTM.
Trailing.
12 months.
This one is a average of like all those multiples up there, the Q ratio, the market cap to GDP, trailing PE, forward PE, the Cape, you know, all these different ways to look at it. And you can argue about averages. You know, some of that might be dragged up. I mean, trailing PE can be dragged, but this is pretty clear that we're in, you know, rare air, basically. And if you combine that with the fact that like there's a potential earnings bubble, it is a very interesting situation we have ourselves in here. And I think that the key question, because you know, again, shorts just got ran over. So they're gun shy, myself included, like, hey, I don't want to do anything. And so the common thing I hear from talking to fund managers, talking to market participants, our conversations is like, I want to shoot it in the back. That's the common theme I hear. But, you know, here's what I would say about the shoot in the back is that if you remember, I was short silver on the run up. Well, it did the whole damn move in one day, right? You know, like it's down 37% in a day. And so the shoot in the back isn't always as easy as you think, right? Like sometimes.
Yeah, I mean, the second move after that initial move was much harder and much choppier, right?
Yeah,
it is lower. Yeah, but it is.
I think that if you are looking to short, you know, it is the rebound on the buy the dip that you want to try. But that's also not easy. We saw that in Micron. We saw that in Korea. I mean, you know, when I did that piece on the gamma hammer, as we put out, you know, that was a good unwind. And it we've done kind of what I said it was going to do, right? I was like, all right, we'll get a little unwind and then we'll roll up for another couple weeks. And right now that's what it's looking like, right? So it is not as easy as just, okay, you get a roll off and then it comes back up and then you fade it there. Sometimes it keeps going. And I think the issue with fading this versus fading a gamma, you know, price, leverage, markets, financial part is that this is real in the sense that it's Capex is huge. And we'll get to that in a second here. Let's move. Yeah, let's move it to, and this is just another one. You know, real quick on this, I like to think about financial claims to real money, right? And GDP, you know, I could have done this 10-2 or whatever, but like claims people think of as money, but really it's a claim on money, right? And so we're in a very long duration position, if you will, or a stretched like, hey, we believe we have this wealth here and we have a bezel. You know, John
Galbraith,
yeah, exactly. You know, there's a great piece that Michael Pettis wrote in 2021 about the bezel and like how everybody looks at the chart and is like, oh, this is how much I'm worth. But then if you don't take it out, well, you know, not everybody can take it out. It's just like because there's no sellers, the price has mechanics that goes up, but there's not actually that much money there, right? If everyone wants to take it out, I think that's a key dynamic to understand.
I mean, listen, it's you know, it's another Buffett indicator, right? He looks at the stock market to GDP. Yeah,
exactly. It's like, hey, these are claims on the assets of the economy, and what's the income of the economy, or what's the actual money of the economy, which is a claim on energy. So it's just kind of putting things in place, and like this is pretty crazy, and it's pretty much like since the GFC been crazy, right? Like we had 22 was a decent little drawdown, but like we're back. Yeah. You know what I mean?
Completely.
And I was on a phone call, and one of the things I want to start doing is being like, okay, look, if you look on the left, that's a chart from Nomura, and it's like I want to figure out, okay, how much Capex is being funded by cash flow, and then how much Capex is their total spend, and then what is the imputed debt spend that needs, or debt funding that needs to happen? I mean, I guess it could be equity too, but like, you know, so far it's basically been cash flows and debt. And there will be a point probably where we're going to start seeing equity deals. To be honest, I think. What do you think about that?
Yeah, well, we're seeing it with the IPOs, but I'm listen. If we start getting Mag 7 common stock supply on top of these IPOs, I'd be really worried.
Yeah,
I'd be really worried about overall equilibrium. That would be a problem.
And I guess that's what I'm trying to say.
In a way, the cancellation of the buybacks is the same thing, right? or the downsizing of the
it's
right.
the first stage of it, right? It's a, you've been in capital markets a long time. It's like, okay, how do you fund it? Okay, first thing you fund it with is cash flow. Second thing you fund it with is, term loan, cheap debt. And third thing you fund it with is the bond market, high yield or IG. And then if you don't have that, maybe you go, just look at MicroStrategy. And then he's doing prefs, whatever. You move down the cap stack to keep trying to fund it. And then once you get to the equity part, that's where you really could get an issue where, we're going to keep this going. So I think that really digging into the numbers is something I want to keep doing, and I am doing.
I think.
And this was just a chart I thought was cute, and I put this little nice version of me as a Brit up there with.
I'm loving your deerstalker hat there, Benny.
Fox hunting or squirrel hunting.
That is smooth, baby.
But you look at this. This is from the Goldman Prime book. I mean, that tells quite a clear story, right? These hedge funds are long on a net and a gross basis, this area. And it's treated them pretty well since Liberation Day, I'd say.
Yeah, as Tony P said in his weekend note, momentum's doing a little bit too much work here.
Look, but it's very difficult because if you're not a momentum guy, which I'm not, and I think that's one of the reasons it led you to starting to do some trend following stuff, because you inherently aren't, but you realize the value of it, right?
Yeah.
Is that this is tough because the natural reaction for guys like us is that we want to fade it, right? And it's been a brutal year of trying to fade that move.
Yeah, I mean, I've grown out of trying to fade momentum. I just step away and rely on my CTAs to do the heavy lifting for me, right?
I mean, I think it's a decent idea because if it's not your natural bias or natural way you're comfortable of investing or trading, that you're not going to do it. So that's why I think the creation of the multi-strategy funds was a good idea, because there's guys who are great mean reversion guys, and I'm inherently a mean reversion guy.
Oh, so am I. I mean, but that's our background, right? You're a fundamental analyst. I was a corporate financier. We're mean reversionists at heart, right?
Definitely, without question. And some guys are momentum guys. And, there's a left tail skew on momentum guys because basically they're going to be earning good returns, but then there's going to be a quarter or a period where they absolutely get drilled. Now, mean reversion just had so far 2 months, the Q2 to date, QTD, if you will, of our version of that, of the left tail skew, where things went, NASDAQ's up 30% since the end of March. It's insane.
Yeah. I mean, I think we mean reversionists get left behind. So, I mean, there are three types of trade as we talk. There's momentum, there's mean reversion, and there's carry, right? And both momentum and carry have left tail skew, right?
Yep.
Carry being the classic pennies in front of the steamroller. Momentum, when leverage gets overextended, the unwinds can be violent, right?
Yep.
And mean reversion, our pain is just no one giving a shit about our trades, right?
Or it could be
relative. It's relative to the other. Our pain is underperformance relative to a dominant momentum factor.
Sure. Or it could be that basically hey, this thing's cheap, it's a good business, no one cares. Or hey, this thing's way over its skis, but it doesn't matter because every day people are seeing, I'm up more money. And so the market mechanics underlying it are basically such that they can let these things stay cheap for too long because there's no flow to it, or it rides like silver or to the moon until it doesn't, right? So that it's hard to be a mean reversionist at both, the up and the down, basically.
Yeah.
So well, I found this one another sanity check that I thought the Squirrel would appreciate. SpaceX IPO versus a couple of the other major IPOs over the last bit. What multiple they came on revenue. Meta, I remember Meta. I got a pretty decent allocation in that IPO. And, they came out at a wrong price. And I remember...
So did retail, if you remember. Retail got absolutely slotted in the Facebook IPO.
Well, and it reminds me of this a little bit because I was talking to someone and I was seeing pre-IPO shares get put around in SPVs that had a big front-loaded fee. I was like, I remember this with everyone was excited about Facebook, and it was just like, eh. And I remember I got a decent slug of that, and I was like seeing it in the up in the market, and it started like selling. I was like, I'm out of here. I'm booking this. And then Morgan Stanley used the whole damn shoe to not let it break deal on day one. It closed at 38, priced at 38, closed at 38, and then went to 17 from there till, I don't know, sometime that summer. And
yeah,
I would think that like people just should remember that. But you look at those are all big companies that were hot. And, you could argue Google was post.com. So, even though it was great, maybe it wasn't going to get the multiple, but
and also they did a funny auction thing, right? They didn't do a regular IPO, right?
Oh, that's right. That good point. I forgot about that. So and just a reminder, which we put in I think our first note, I put that in of like, here's how the returns look.
Yeah,
they don't look good. All right, they're buying day one. They just don't look good, and it fundamentally makes sense when we in this show we try to harp on mechanics. Well, there's a lot of guys who have supply, and they're going to get really rich, and they are just waiting to sell. They're waiting for the moment they can legally sell their stock, because they're not playing for 2 trillion to 4 trillion. They're playing for, I want to get the F out. You know what I mean?
Yeah. Hey, by the way, I love what you've Nano Banana's been doing to our logo. You got your Boy Scout on the right and the 1920s civil servant on the left.
Yeah, we're having some fun. This is our way of exploring the AI. You know what I mean? Like seeing what it can do for us versus, unfortunately not participating in the memory stock boom.
Yeah, I know. No, I listen. It's been an all-timer of a trade, and
all time.
I was turning up my nose at it the whole time, right? I just couldn't believe it. I've just got too much history with the sector. But congrats, guys. But cash in, right?
It is just one of those things where, like, again, we just told you we're mean reversionists, so listen to us at your peril. But again, I was telling you about silver, and it was going up, and then one day it goes down 37%. That will happen here, and I guess that's why I'm starting to focus on the funding and the sustainability of the Capex. Because Rupert, I mean, did you hear? Uber comes out and says, "Hey, we blew through our whole token budget in Q1," or what by that, right? And then it comes out that Amazon was like, "Oh, we spent $500 million in tokens in one quarter," and it comes out Meta and a few guys have token boards so that people are competing on how many tokens you spend, which is not the actual right thing.
I don't understand. I really don't understand that. And I certainly don't understand why that's bullish, right? So my concern is, the classic Goldman chart about token consumption that's being thrown around, showing this sort of parabolic curve. I think so much of that extrapolation is based around what I see as almost fake token action now. If people are literally just blasting through, tokens to, create slop, because that's the incentive structure that's being built in some places, how can we build a forecast off that back? Particularly if these things are getting more efficient.
Very difficult, right?
Yeah.
I mean, and I think that's where the struggle comes for a lot of people of like, how do you think about this? Because a bull will say, well, the earnings are there. Okay, well, the earnings can be there when copper prices rip through the moon or steel or whatever, but are you really going to put a huge multiple on it? So you have to kind of like really look out at what's the sustainability of this Capex. And that's what I'm saying, comes out this week, that a $36 billion private credit deal got done to fund Anthropic's chip buys. Okay.
Yeah.
And you got, we've chronicled it since the show started, talking about how Meta did that private, data center. And so debt funding is very much part of this. And it can't be surprising that Magnetar did well with CoreWeave because they were early on it, just like they were with their CDO trade back in the last time we had an earnings bubble, if you will, and debt funded earnings bubble. So that's what you got to think about.
That's a great point. It's the same characters.
Same characters. Look, they crushed both of them, and then they got out of both of them, and like, good for them, smart guys. But like, just remember, that's why like I'm doing work in CoreWeave, because I'm like, the other side of it was a great trade also. And so
how much of CoreWeave does Magnetar still own?
I
think
my Bloomberg's off, and I don't want to mess with the thing, but I know that they've made over $10 billion on the trade.
So, okay, that's a reason to look out for the show notes, guys, and a reason to be a subscriber to our stacks, because I will look it up, and I want to check how much Magnetar still own. Anyway, yeah. We've hit the half-hour point. I've got a massive day today.
All right.
I need to get running. Guys, thank you for joining us on the Sunday show. We love you here. See you on Thursday. Quick preview. Amish, your buddy's coming on Thursday.
Yeah. So we'll talk about data centers on Thursday. He is CIO of University Asset Management, and basically I've been working with him a bit on the CoreWeave, and we're going to talk. He funds some of these data centers, so it'll be a data center Thursday this week.
Fantastic! Can't wait. All right, guys. It is 6:20 p.m. Eastern, Sunday the 31st, and it's Benny and the Squirrel out.
All right.